Welcome to another video. Today I will be sharing with you a very special trick that you can be using in your trading to capitalize on huge moves in the market, and it's probably something that you never heard about. Now, if you're new to the channel, I'm a top author on the TradingView platform and I share free education and analysis on all my platforms, and you will be finding a lot of value in this video, so I suggest that you watch it until the end. Okay, so in today's video, what we will be speaking about is a very important trick that you can be using when you are analyzing the market to find good probability continuation zones in the market. Now, specifically, this is a trick that involves using the Fibonacci retracement tool to spot when the market is ready to continue to the upside. So after an impulse and a correction, to continue for the next impulse to the upside. And I will be showing you a live example of this principle and how we used it with students to capitalize on a nice opportunity. But first of all, I want to share with you what is a valid impulse, because if you don't know that, then obviously the whole concept will be very hard to explain. Now, what is an impulse? An impulse is a very strong move in the market that creates either a higher high or a lower low. Now, as you know, the market moves in waves, and these waves are nothing less than a simple series of impulses and corrections. Each one of these moves to the upside that creates a higher high is an impulse, and these moves to the downside are corrections. Now, after an impulse and a correction, you expect continuation to the upside, and these moves to the upside are very good opportunities as a swing trader to capitalize on a very nice move to the upside with a good risk to reward. Why? Because you are catching the longest move, right? So entering when the correction is over. Now the question is, how do I understand that the correction is over? Well, obviously you can go on lower time frames and monitor the price action, but with the trick that I'm sharing with you today, things will get easier because you will know when it's time to actually go on lower time frames to monitor price action. Just a quick reminder, make sure you comment below and you let me know which pairs topic you would like me to cover in the next video. So let's start by defining what are you supposed to be doing with your Fibonacci retracement tool. So after an impulse in the market, you want to measure the retracement. Now, how do you measure a retracement? You use the Fibonacci retracement tool. So taking your Fibonacci from the low to the high of the impulse. And what you want to see the market reach one of the Fibonacci levels. Ideally, you would like to see the market reach the 0.618, but sometimes the market will reach even the 0.786 before the continuation to the upside. But this is not how the market moves most of the times. Most of the times, after the market reaches the 0.786, for example, the market will break above the Fibonacci levels. But keep in mind, this was the first step. The market most of the times will go for a second step. So if it just tested the 0.786, it will test as the next Fibonacci level the 0.618, and then it will continue to the upside. Okay, very important to understand this. If a market manages to retrace all the way back down to the 0.786, the market will reject it, then go for a test of the 0.618, and then make the continuation to the upside, creating this W formation. But W formations, I already spoke about them in other videos. Now let's see a live example of this. Now, we took a trade on USD Thai baht with students using exactly this concept. Now, obviously, if you don't know it, with students, we use also COT data. So basically the commitment of traders, what hedge funds are doing in the market. Now, if you don't know what these tables are basically the positioning, literally the positioning of the biggest speculators in the market. So hedge funds and how they are trading. What are their positions? They are forced to report their positions, and by understanding their long-term positioning in the market, you can understand you can have an edge over your competitors in the market. because you know what they are doing. Now, we obviously used also this for a further confluence to our trade to the upside, but we used a very special trick here. That is this one that I just explained to you guys. What was the situation in the market? We had this impulse to the upside, a strong movement that created a higher high. And we wanted to measure this retracement. How do we have to measure this retracement? We just saw it. We have to take our Fibonacci from the low to the high of the impulse. And what you can see that the market went for a test basically of the 0.786 Fibonacci retracement, exactly as we have just seen in our example. And then the market rejected the zone to the upside. Now, as we just said, if we have the market that tested the 0.786, what is the next level? You want to see the market go and test the 0.618. And then from here, you want to see continuation to the upside for the completion of the impulse, correction, and impulse pattern to the upside and creation of the W formation, exactly as we explained in the didactic example. So let's see what actually happened. The market went for the retest of the 0.618. At that point, what are you supposed to be doing as a trader? At that point, once you have the direction of the market, which in this case is to the upside, so from a daily perspective, you know that the market is supposed to be following with a nice move to the upside. What you can be doing, you have to go down on the 4-hour time frame, because it's the most accurate time frame for entry, and understand where is the best entry with the better risk to reward to the upside and better probabilities with a stop loss that is protected by structure. Now, with students, we have very specific rules when it comes to entry, and I suggest that you have them as well. You need to know clearly what are all your rules for entry, your rules for direction. You need to have a clear rule-based strategy, because that is something that you can test and that will give you an advantage in the market. Now, from a COT perspective, we knew that basically during the move to the downside, hedge funds weren't really adding proper shorts, meaning that they weren't interested in the move to the downside, because if a market is moving down and you're not adding more shorts, it means that you're not interested in the move to the downside. And if hedge funds are not interested in the move to the downside, the market will continue higher. So if you see a market is going down and in the short positions, you see that they're not adding short positions, clearly the market will continue to the upside. So how did we approach this from an entry perspective? Now, obviously, I can't tell you exactly why we executed the position here, but I can tell you some of the rules. I can't tell you all the rules. I can tell you the simple, basic technical analysis reasons for which we executed the trade here. The market broke this counter trend line. Why counter trend line? Because we know that the trend is to the upside. Therefore, if a trend line is to the downside, it's a counter trend line. That is the technical name for it. The market broke it to the upside, also broke this structure, previous resistance, will be turned support, creating a confluence of support after the break of this counter trend line. We entered on the break, stopped below the low, protected by structure, and take profit at the minus 0.272 Fibonacci level, taken obviously on the retracement. Why taken on the retracement? Because if you want informations on a move to the upside, you have to take your Fibonacci on the retracement. In the same way as when we wanted the information on the retracement, we took our Fibonacci on the impulse. Always take your Fibonacci on the previous leg. So this was a very nice 1 to 3 risk to reward to the upside trade. Now, if you have the possibility to take a trade to always take trades with a minimum 1 to 3 risk to reward, what you will be able to do is to be always in profit in the long term, because you can only be right 3 times out of 10. So even if you have a terrible performance that month, you take all bad decisions anyway, you will be in profit. And if you are trading with a good win rate, you will be in huge profit, because when you win 3 times what you lose when you lose. And as you know, 3 times 3 is 9, minus 7 is 2. So even if you write only 3 times out of 10, you're still in profit. And that is the key to long-term consistency, and why this trick that helps you understand when the next continuation is supposed to start will help you ride the bigger moves for the biggest risk to reward, therefore helping you be consistent in the long term in the market. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free content on all my platforms, as well as going and checking out the mentorship program. You find the link in the description. It's a very complete program. You first learn all the rules of my strategies, and then you trade them live with me. Each and every day, I give you a new daily market breakdown showing you how to apply the strategies with entry, stops, and take profits, as well as answering every question that you have each and every day. So you can click the link and go and check it out, or I will see you in the next video.